What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my stock market monthly update series, where I give you a quick rundown of recent events and the current status of the stock market and the economy at large by splitting it up into three parts. In part one of the video, we look at the performance of the stock market and how things are going so far. Then in part two, I cover any current or kind of recent events within the stock market and the broader economy, which today we'll be talking a little bit about the debt ceiling, inflation, interest rates, and a few other things. And I'll give some predictions on where I think we're heading and what I'm doing myself in the stock market right now. And then in part three, we finish it off with just a quick rundown of some of the biggest gainers and losers over the past month and cover any related topics to those individual stocks as well, which, by the way, this past month I had a lot of my own personal stocks make the gainers list. And we're also going to take a look at some big drops this month from Target, Anheuser-Busch, and a few others that are very interesting to look at. So it's going to be a lot of fun to kind of dive through all of these individual stocks as well. Now, by the way, I'm supposed to be posting these monthly update videos at the start of the month, which I know I'm super late on it this month, but I just wanted to do a quick update for you guys anyway, and then we'll just do another one at the start of next month. Reason I'm a little late is because I've just had a lot of stuff going on recently. As a lot of you know, I've been transitioning my career away from teaching over to doing YouTube full time. So there's just been a lot of stuff going on behind the scenes. But we're here with an update. It's going to be fun. I love doing these update videos for you guys, and I hope you enjoy them too. So let's not waste any more time. Let's just go ahead and dive into it. We'll start with part one. All right, and kicking things off here with part one, that's going to be an update on market performance, which we can see right away here that the S&P 500 continues to have a pretty strong first half of the year, as it is now up almost 14% year to date. And while it is still down about 10% from the top, it's obviously no longer in a bear market, which unfortunately means that there are less deals available now than what we've had in previous months. And that's especially the case with the tech-heavy NASDAQ, which is now up a monstrous 29% so far this year. Although it is still down more than the S&P 500 from the top at a 16% drop, but unfortunately, we no longer have a bear market here either. And I know that may sound a little weird to say unfortunately, especially if you're new to the channel. You might be wondering, why am I saying unfortunately if stocks are going up? Well, the reason why my longtime viewers know that I like to buy my stocks much more heavily when they're going down. When prices are going up, I just don't see as many good deals out there. So I'm just not going to be as happy about it. I actually like it when stock prices are going down. And you'll probably know that if you've seen any of my recent videos over the past year, I've been talking heavily about buying stocks during all of these dips and all this volatility. In fact, some of the biggest gainers that we're going to talk about at the end of this video in part three are actually stocks that I own myself that I've been, kind of preaching about throughout all the past year. And so that'll be kind of fun to take a look at there. But again, I'm not actually really happy to see that. I'd rather stocks be going down so that I could get better deals on them and buy more. I'm always trying to build up my portfolio as large as I can for the long term. Having said that, that's not to say though that there are no longer any good deals out there in the market. In fact, I'm a firm believer that there are always great deals out there in the market. You just have to be willing to put the hard work in, do the research, and go find them. It's just not as easy to find them as it was before. But having said that, is the recent rally in the stock market, is it justified? Or is the economy a bit worse than maybe people think? And, might the stock market be heading back down into a bear market? Should we be expecting some volatility, maybe some better deals coming up later this year? Well, let's go ahead and transition now to part number two. We'll talk about any updates within the economy and the stock market so we can get a better idea of it. I'll try to give some predictions myself too. All right, so let's just run through a few things here. Now, one of the reasons why the market has been holding up, especially like very most recently, is because the debt ceiling deal just finally got passed. See, America has so much debt that it constantly needs to raise its borrowing limits so that the country doesn't fall into default, which could cause the economy to crash and send the stock market falling right along with it. That's not to say, though, that raising the debt ceiling is a good thing, as it's not actually solving any of our debt problems, which most experts would argue that it's not sustainable. but the stock market still likes to see a deal get passed because it at least means that the country isn't going to immediately, financially fall apart, at least not quite yet. Anyway, the deal was agreed upon by both Democrats and Republicans to suspend the debt ceiling until 2025, and it was done with some give and take from both sides, involving things like new worker and benefit requirements, getting back some unspent money from the pandemic, and Republicans also refused to include any new taxes on it, while also calling for funding cuts to be made to the IRS, although most of that is still there anyway. One big compromise that is sure to affect a lot of people, though, was to end the student loan moratorium, which I'll come back to a little later when I cover SoFi as one of the biggest stock gainers of the past month. But aside from the debt ceiling, most eyes are now back on inflation and interest rates, which very directly affect the stock market. And on the inflation front, numbers have been improving for some time, with April coming in at less than 5%, which is dramatically less than the over 9% high of inflation that we had last year. And on the day of recording this video, we actually just got May numbers in as well, which continued the cooling down streak, as it was another decline, this time all the way down to just 4%, which is dramatically better than those previous highs. It also means that we'll probably get a rate pause, an interest rate pause, after the staggering amount of interest rate hikes that we've seen over the past year, which now sit as high as they were, right before the Great Recession. In fact, the Fed should be releasing that announcement on the interest rate either hike or most likely pause on Wednesday, which is probably the day that I upload this video, so you'll probably have that information by the time you're watching this. But according to the CME Fed Watch tool, the chances of a rate pause are sitting at just about 100%, so it's very likely to be paused, which again is partially the reason why stocks have been climbing recently. The hope is that we come out of all of this with a soft landing if inflation continues to drop and the Fed stops raising interest rates, which would otherwise increase our risk of a recession if they were to keep raising them by a lot. However, it should be noted that another increase is still expected in July at over 66% odds, so we're not anywhere close to being out of the woods yet. This does, however, bring me to another topic that I wanted to quickly discuss, which are earnings, because I've been actually using these to kind of try to gauge the economy a little bit, kind of where we are by looking at earnings. And so far, it's been better than expected, which is another reason why stocks have been climbing this year, as almost 80% of S&P 500 companies reported an earnings beat for the first quarter of the year. However, the second quarter is looking like it'll be much worse. And to be honest, Q1 wasn't even as good as everyone thinks it was either. Yes, it beat estimates, but it was still an overall decline year over year by over 2%, which was already coming off of another decline the quarter before. So that's a technical earnings recession, guys. But if that wasn't even bad enough, Q2 is now expected to be another decline, this time of over 6%, which was not only revised down recently from 4%, but it would also mark the biggest drop since the 2020 recession when the pandemic started and we were under heavy lockdowns, so that's pretty bad. On top of that, FactSet is predicting that companies will need to beat estimates by an even bigger margin this quarter to impress investors since the economy is so weak. Basically saying that just beating estimates alone may not be enough this time to really move the needle to get stocks climbing higher. In fact, they note that companies who reported positive earnings surprise last quarter only saw their stock prices increase by an average of 0.4% in a 4-day span from before and after reporting. So that's less than half the 5-year average that we would normally see. And as such, they predict that stocks are currently, priced to perfection given the recent climbs in the market, and they may not see very good performance on that second quarter. There is, however, some optimism for the future as EPS numbers are then expected to see a large recovery with just barely a slight increase in Q3, but then a giant 8% recovery in Q4. And despite the current headwinds, analysts still predict that the S&P will finish positive for the full year at 1.2% earnings growth with over 2% revenue growth. And then the next year in 2024, it'll be way higher at over a 12% earnings climb with also about 5% revenue growth. So that's around 10 times the EPS growth and about double the sales growth of 2023. But the thing is that we're not quite there yet. We're still not out of the woods. And I feel like the stock market is almost being priced like we are. I feel like it's being priced as if we are just expected to have a soft landing here coming out of this insanely high inflation and really high interest rates. And I'm just not convinced that that's going to, for certain be the case. In fact, I think Q2 earnings are being set up here to actually disappoint. And I wouldn't be surprised at all if we actually have some volatility in the market and you see some big dips. And I wouldn't even put it past us that we could potentially go back into a bear market this year. In fact, I think a recession is still on the table. Guys, I'm actually going to talk about Dollar General stock in part 3 coming up in just a second. And they actually just released earnings. And they said that even some of their customers, by the way, they released bad earnings, we'll talk about it, but they said some of their customers are actually turning to food banks, meaning that they can't even afford their products. So to me, the economy is still looking very shaky to say the least. And with inflation, still elevated, and with us still willing to raise interest rates, I mean, I think we're still going to see higher interest rates in the future. I wouldn't put a recession past us. But again, I still think that the longer term picture is still looking much brighter, because even if things go really bad, even if we go back into a bear market, even if we have some volatility here in the short to medium term, guys, in my opinion, that would be a huge buying opportunity. I keep saying this, guys, in like every monthly update, but just keep in mind, we have very high interest rates right now. That's almost a guarantee that the stock market will skyrocket off of a crash, because all we have to do is lower those interest rates and the economy and the stock market are going to rebound. It's just like it almost always happens that way. So, I'm not a fortune teller. I'm not trying to make huge predictions here, but I'm just saying, if you ask for my opinion, I think we might have some volatility here this year. I'm not convinced that this very strong market rally here is going to continue to keep roaring up higher as it is. I think there is room for disappointment when looking at earnings and the economy. And if we have some volatility, if stock prices go lower, in my opinion, it would be a huge buying opportunity. So I'm really hoping for that. But regardless, it doesn't matter. I'm still going to be buying stocks because, again, worst case scenario, even if I buy stocks now and they crash, we have those high interest rates. We'll just lower them, and then the stock market will roar again over the long term. So long term, the picture is still intact. I'm just not really worried about anything at the moment. I'm still just trying to find the best deals I can. I'm searching, I'm digging through all the stocks, and I'm trying to find the best absolute deals that I can find. If I find great deals, great. I'm picking those up. If not, okay, I can be patient. I think there's going to be more volatility. That's my opinion. Anyway, speaking about individual stocks, let's go ahead and finish up the video now with part 3. Talk about the biggest gainers and losers over the past month. All right, and starting first here with the biggest gainers, a few of my stocks absolutely skyrocketed over the past month, with Palantir, SoFi, and Tesla all making the front page here with gains of 57% for Palantir, 51% for SoFi, and 44% for Tesla. Palantir and SoFi are two of my smaller speculative stocks, and they had a great month coming off of strong earnings, with Palantir also benefiting from the recent craze in artificial intelligence, as well as another multi-year, almost $500 million contract being awarded by the U.S. Special Operations Command last week. This is a high-flying company with AI data management and analytic tools for both governments and corporations that I think will only grow larger over time, but the stock is now sitting near a 52-week high after more than doubling so far this year. So I probably won't be buying any more shares at this time. However, I don't plan on selling any of my shares either. It's just kind of a hold for now. I really still like it long term. And same thing basically goes for SoFi here, who also soared this past month, leaving it up almost 100% year to date, and even more from the lows, which I actually bought more shares at those lower levels myself too. But I probably won't be buying a whole lot more of the stock at this time either, unless it dips again. In SoFi's case, though, they got a big lift recently from the student loan pause that is now scheduled to end around the end of summer as part of the recent debt ceiling deal, which is a huge part of their business. And so now you'll likely see a lot of student borrowers coming to SoFi to refinance their loans. On top of that, they also got a boost this year from strong earnings and an announcement that they're even planning to reach GAAP profitability by the fourth quarter of this year, which would be huge. And just overall, SoFi's business has really been on fire, growing their members by over 4.5 million since the start of 2020. That's over 420% growth during one of the worst economies ever. So I think that's pretty impressive. And SoFi remains one of my favorite fintech speculative stocks to own long term. And then with Tesla, they've been soaring for many different reasons, but some of the most recent announcements include a planned rollout of new autonomous features. They're also planning to start advertising for the first time ever ahead of new upcoming models like the Cybertruck and others. It's a big deal. Tesla has never advertised before. And there was also a couple of partnership deals, very surprising ones, announced with both Ford and GM to let them use Tesla's supercharging network, which opens up a very large new revenue stream for them. And they're even thinking about licensing some of their autonomous driving technology out to other brands in the future too, which could push, those new revenue streams could push them even further. As far as the stock goes, though, it is still down a lot from the all-time highs. However, after more than doubling this year, I'll probably just be holding on to my shares for now. It's like my third largest stock, somewhere around there, second or third. So, yeah, I'm probably not going to be adding any more shares myself. Okay, I'm going to try to go a little faster now because we're running low on time, but scrolling down the list a little bit, NVIDIA also skyrocketed recently with 35% gains this past month, and year to date it's almost tripled in size and is now trading at an all-time high. It's so high, thanks to better than expected earnings and all of the recent AI hype. It's really just flooded into the stock. This is another large stock of mine that I will probably just be holding for now, though. A few other notable mentions include the furniture e-retailer Wayfair climbing over 40%, while Adobe, AMD, and Match Group all had climbs above 30% as well. I do not own any of these stocks myself, but I've always liked Adobe and AMD, and I even think Match Group has some potential as well. They're actually one of the stocks that I included in my stocks to buy video from a little while back, and they're the company behind online dating sites like Tinder and Hinge, which I do think have a lot of long-term potential, especially Hinge, but I'm not invested in the stock myself. It's just a little too risky. And finally, I'll just quickly show you the mid-cap gainers, because one of my own spec stocks, Upstart Holdings, actually came in as the second best performer last month at almost 130% gains, which is just unbelievable performance. Now, they're an AI fintech, and the stock soared because of their financials rebounding, as well as a recent deal to sell billions in loans to Castle Lake, and all of it probably caused a short squeeze during the recent AI craze. I did actually sell a little bit of the stock just to lock in some profits, but I'll for sure be holding on to the rest of it long term. It's a stock I like. By the way, C3.ai is another spec stock that I had in my 3 AI stocks ready to pop video, and they also soared by 86% this past month. And the other 2 stocks in that video, by the way, they also soared by a huge amount too. Okay, we got to finish up with the biggest losers now. We're running a little long time, but right off the bat, I see a couple of discount retailers here, including Dollar General, who is down over 30% in the past month, and Dollar Tree, who dropped over 15%. Now, this primarily had to do with Dollar General reporting earnings, which fell short of analyst expectations on both the top and bottom line. And to make matters worse, they even lowered their guidance while also cutting expansion plans to save some more cash, which is a clear indicator that the weak economy is starting to weigh on the consumer. In fact, the CEO specifically pointed to that in the earnings call, and he even went as far as to say that their customers, a lot of them, are actually turning to food banks instead of shopping at their stores, which is pretty crazy. I mean, it's a sign that the economy is not doing so great. As far as the stock goes, it's now down over 40% from the top, and it's even trading below pre-pandemic levels with a valuation that is also cheaper than the sector. So I would actually be interested in this stock, but I was hoping that it had a good dividend. It doesn't really have one. The dividend only yields around 1.5%, which is just too low to get me very excited for a retail kind of stock. It does have some good growth metrics on the dividend, but the yield is just too low for me. And Dollar Tree, by the way, doesn't even pay a dividend at all, so I'm not picking those up. Apart from that, though, all eyes have mostly been on Target and Anheuser-Busch this past month, who are both experiencing some boycotting because of certain social topics, which I'm sorry, guys. I just really don't want to go too deep into these topics because this is really just a stock market investing channel, not a social or like political based channel. But just looking at these from a stock investing perspective alone, Target fell by close to 20% this past month. And if we scroll down the list a little bit, we can also see that Anheuser-Busch fell over 13%. Now, Anheuser-Busch stock, I've never really been a fan of myself because I actually think Constellation Brands is more interesting with also strong beer and wine brands, but an overall better dividend too, as Bush only yields 1.5% with a negative almost 30% growth rate on the dividend, while Constellation Brands yields about the same amount but also has a tiny payout ratio and actual growth on the dividend of around 7% with 7 consecutive years. So I just like it more for that. However, the best of all of these in terms of a dividend would actually be Target, who not only yields more than double the amount that these do at 3.4%, but they also have a double-digit growth rate with over 5 decades of consecutive increases. So that's essentially a dividend king status. But even here, I'm just not a huge fan of Target either. Yes, the stock is down a lot, having now lost over half its value from the top, but it's still trading well above the pandemic lows and mostly above the pre-pandemic levels, which were usually below 100, and yet, even with the recent controversies or the boycotting, they're still trading above that, that important $100 mark. They're still sitting at around 126 today, so they're still a bit higher. And valuation-wise, it's a bit of a mixed bag too, as it kind of depends on what values you're looking at. They have a trailing PE ratio that is actually more expensive than the sector and more expensive than their own 5-year average by around 15%. But the forward PE ratio is around 15% cheaper. So it just kind of depends on which one you look at. But if you want to know what sort of, I guess, controversial stock I would actually think is the best pickup right now on the dip in terms of like recent social and political, issues or debates, I would actually say that it's Disney, which, by the way, they actually made the losers list this month at over a 10% drop as well. And from the highs, they're also down over half their value. But unlike Target, Disney is actually trading near a decade low, and they're also well below that $100 mark that I would argue is also crucial for Disney, just like it is for Target. And when you look at revenue growth expected this year, Disney is still expected to grow by 7%, while Target is only expected to grow by barely 1%. And even worse is the next 5-year expected earnings growth, where Target is actually expected to be negative at an average decline of 8% per year, while Disney is actually positive by a monstrous 22%. So you guys tell me who has the stronger brands here. I mean, if you're asking me to choose here between Anheuser-Busch, Target, and Disney, I would say that Disney is the hardest to probably boycott, because think about it this way. Anheuser-Busch, there's so many beers out there. Anybody can choose any other beer if they really want to boycott them. Target, Target is probably a little harder to boycott, but I'm sure a lot of people, especially in this economy, wouldn't mind so much going to shop at Walmart or even Amazon where you can get cheaper prices. So maybe that's a little easier to boycott. And then, but Disney, I think Disney still has some very strong brands. There's not much of an alternative to like Disneyland. There's not much of an alternative to like Disney cruises and resorts. There's not much of an alternative to in terms of like their cartoons and family content from Disney and Pixar. Still a lot of people really want to watch that content. And then of course you still have Star Wars and Marvel. Those are very strong brands. It's hard for, as much as people, if people really want to boycott them, it's kind of hard to stay away from Star Wars and Marvel. So I just think that Disney has the stronger brands and they're expected to perform better. So I don't know. Again, guys, I'm sorry. I don't like to get into all the controversial stuff. I don't like to give opinions on politics and social topics. I'm just talking about stocks. I do own Disney stock myself, so maybe I'm biased, but I just think Disney, as just a stock, from just a stock perspective alone, I think it's looking more attractive than the rest of these. But anyway, that's just my opinion. I'd love to hear what you all have to say down below. Let me know. Drop your comments down there. We can have a discussion. Thank you so much for all the support, everyone. I really appreciate everything that you guys have done for me, and especially everyone that's signing up on Patreon, joining us on Discord. It's so much fun, and it just means the world to me. So thank you for all that support. And I'm going to catch you guys in the next video. Take care, my friends. All right. Bye-bye.